retirement funds also have a very specific role because they allow you to invest in a disciplined way. What would be the right mix? What would you advise? What would you look at doing personally to build that retirement corpus?
I think today it all depends on the risk appetite of an individual. And when we talk about risk appetite, finally one can look at investing in a blend of debt and equity. One can invest in equity if he is totally evolved and he understands the market well. So he can go into a more of an equity. But ideally what we have seen is that that investors today have products like PPF, which they have been investing for years. And that's a corpus which they normally build and they use it after retirement. So that's the first part.
Yeah.
Though it is having a 15-year lock-in and then renewal after every 5th year, then it's all that is fine. But they are building a decent kind of a tax-free kind of a portfolio corpus. The second, you have the bank fixed deposits, or you have, other than that, you have mutual fund.
Correct.
Now within mutual fund, you have diversified and you have also solution products like retirement.
Yeah.
Okay. Now, like Dhawan Mr. Dhawan spoke to, he made a very clear kind of a understanding, gave it a very clear thoughts that, that there are options available for investors in terms of choosing either a debt or an equity or combination blend of debt and equity. So the only point for a retirement fund is that it has a lock-in of 5 years.
Correct.
But otherwise, if you look at in terms of if it is an aggressive,
hybrid fund,
aggressive product, then you are investing almost 80% investing into an equity.
Correct.
And the rest is 20%.
Correct.
Like in our retirement fund, there are 4 variants. You have aggressive, you have aggressive hybrid, you have conservative hybrid, and you have conservative. So it all depends on a customer that whether he wants to go for a conservative or whether he wants to go for an aggressive.
And during the life cycle of that particular fund or product, the asset allocation remains the same, or can it change?
So
it changes, it can change, like in a balanced advantage fund and all. The asset allocation can be very dynamic. But what about this retirement product?
So depending on what an investor chooses, the investment is done in a very similar fashion of investment, not only on the debt side, but also on the equity side.
Correct.
But one has an option once in a year to move it into a different option.
So, Vishal, help us now to build the perfect retirement bouquet. So many options. There is retirement funds, diversified mutual funds, there is the NPS, there is EPF, and there are some of these, insurance products as well, and annuity products. What do you like the most, and how would you, make the bouquet? Let's say if you were to make it for someone like me.
So I think the NPS is a very, very powerful tool, because what it does is it also gives you a very unique tax benefit, which doesn't exist elsewhere. If the employer chooses to contribute on your behalf. And what it therefore does is that, up to 10% if you're in the private sector, or 14% if you're a government employee, when the company contributes as a percentage of the basic plus DA, that actually becomes tax-free, and therefore it defers your tax on that element. And that's very, very interesting, because you don't have that option anywhere else. So I would say that, a lot of people saving for retirement should look at the NPS very carefully because of this unique tax position that exists. The other advantage of the NPS is that, it sort of gives you the ability to get a lump sum when you retire, and you can now choose, when you want to retire, because you can, defer it all the way up to the age of 75 if you want to, and take out 60% tax-free, and then 40% can be annuitized to give you a regular income. So this is a very sort of nice thing for a lot of investors to think about. And therefore, in a retirement portfolio, we think NPS definitely has a role to play. In addition to that, the Employee Provident Fund, because of the fact that, first of all, it happens by default, and the second is that it does end up, feeling very safe for employees, and it's got what I would call a subsidized, higher than normal fixed income rate, because you get the benefit of triple E on it. Your contribution is exempt from tax if you're opting for the old tax regime. You have the interest that you earn up to 2.5 lakhs a year exempt from tax, and then you also have the withdrawal exempt from tax, which isn't there in any other retirement product. So the EPF comes as a part of that, and then you take the choice between a retirement fund if you think that you need the discipline of a lock-in with it, or if you feel that you're able to label well enough and not become indisciplined with using diversified funds, then you use diversified funds. So this combination of NPS plus EPF plus the choice between a retirement fund or a diversified fund is a great combination. Annuities are an option because they protect you from longevity, but the rates of return tend to be low. And also you end up losing access to principal very often. So, unless your portfolio or your retirement pool is large enough to say that, some part of my money I never need to see during my lifetime, I'm just happy earning the interest on that. I think otherwise you'd find it a bit of a struggle.